Good afternoon, good evening. Thank you for joining us. And I've been waiting for this quarter for about 5 quarters now. When will I officially start by congratulate you on a beat? So congratulations. Numbers have been very strong. Walk us through what transpired for the quarter gone by before I get into specifics. Your volume growth, is that just because volume growth, if I compare Q4 of FY15, Q4 FY14, it is better than that.
Yeah. It's been a very strong quarter. The best part of the quarter is that if you look at our core segments, which is either North America or BFS, both of them have performed well ahead of the company averages. We've been calling this out, this momentum for the last time also I told you that structurally it's very good. While the aggregate was still not as good as what we wanted it, structural components have been turning positive. North America has come in at 2.4% volume revenue growth on a constant currency basis. Europe has come in at 3.6%. BFS for the full year, we are now exiting at 14.8%. And the core segment, momentum in the core segment is what sets us up nicely. And that has been the highlight of the performance this quarter. Volume growth is strong, it's fairly well distributed. And most of the headwinds that we had are either behind us or subsiding as we go into the new year.
Your volume growth or revenue growth, let me put it this way, your revenue growth is lacking the volume growth. Is that largely because of pricing? Is that largely because of a dip in margins?
What we report on a Q-on-Q basis is really the realization, and realization is very volatile. It has multiple things, as you spoke about the one great working day.
So that one day helped your margins, helped your realization for the quarter gone by?
No, it's a more complicated one. On fixed price projects, it actually will not do that, or in managed services, whereas in T&M it will help you. So the Q-on-Q variations on that is not a very good indication on the side. If you look at the full year, for FY15 to FY16, once again, where realization has come in almost flat. It's only down by about 0.1%, and which was the same story last year also. So as we said, overall on an aggregate basis, pricing and realizations have been in a fairly tight band, and we see that as we go forward also.
Ajay, the canary in the coal mine from an IT company which does not give guidance is the guidance number for employee addition for FY17. And you have already indicated at the press conference that number of fresh hirees would be less. Is that because you expect the attrition to come down dramatically? Dramatically is the word here, or because of new technology, new training, your requirement of employee has gone down?
Okay, so there are two basic aspects to this. One is definitely we are saying that our gross addition as far as next year is concerned is going to be down as compared to what we have done this year. Now, what we have announced already is that we have given offers to 45,000 trainees, so they will come and join us. We expect about 32,000 based on past statistics if we go by that. Now, the remaining hiring, as we are saying, we will calibrate it as we go forward. Now, there are two reasons why we are saying that this gross number is going to be drastically down compared to last year. One, there will be a lot of automation, and in terms of productivity improvement is something that we are talking about, which we have been talking about for a while. But I think we are at an inflection point where we can see that automation and the productivity improvement actually playing out and giving and yielding results. Second is, if you look at my attrition numbers, 2 consecutive quarters, LTM is down. But if you look at the quarterly attrition, the number of people who leave in a quarter, so last year Q4 versus this year Q4, there is a 60 to 70 bips. It's gone down. So the direction is absolutely right. So given that, the hiring that we do for taking care of attrition, even that is going to come down. So we think that these two factors will play out, and as a result we need not hire the number of people that we are hiring, and even the technology is going to come in a big way in improving the productivity of our people. So these are the
But do you expect revenue per employee to go up?
See, if you are not hiring the number of people that you have, and that's what I think Chandra was mentioning, that if you look at the last 5 years, the incremental revenue that we have got, the productivity or the revenue per person of that piece has been pretty high compared to our overall revenue per person. So that definitely, you are getting into new technology, you are getting into new deals. So as a result, the new areas, so the revenue per person is expected to be higher.
Has the excitement at TCS headquarters waned away slightly of Q4 numbers because of the Epic system issue?
Not quite.
Wish it would have happened.
No, it's something that has to be dealt with. I think we're fully approach of the matter, and our teams on the ground are dealing with it. We are fairly confident about the fact that we are dealing with it as it required. It's something that needs to be taken care of, and it will go through a process. So it's business.
Well, the numbers are out in the open about the claim size. Now, as a listed company or as a non-listed company also, you have to make some provisionings. So, from your contingent liability fund, have you made enough provisioning?
We're dealing with it as per the standards, and standards are fairly clear. You make an assessment of the nature of the claim and the certainty of the occurrence of it. And currently, based on our assessment of it, we have given a full disclosure to it in our contingent liability. So the total amount is put in the contingent liability, and we have given an explanatory note on that. And as the the situation develops and further data points emerge, we will continuously evaluate it and decide to deal with it whichever way.
So you put $950 million in contingent liability?
On contingent liability, yes, absolutely.
Okay, and then now it is subject to probability and subject to the development.
Right. That's right.
Your competition may use this as a ticket to talk about TCS has not followed best corporate practice. Could this lead to a business loss in a competitive environment?
I don't believe so. Customers, if you see, 98% of our revenue comes from existing customers, and our customer relationships are very strong. Most of them go back multiple years, and the nature of the relationships are such that they understand TCS and understand who we are. So while there might be concerns, and we are proactively reaching out to address any concerns that are there, we believe that our customer relationships are very strong to survive this, and for them to know what we are talking about and who we are. We have 800 odd key customers, and they are customers who know us very well, and the relationships are, as I said, multidimensional across people. They know the company, they know the culture, they know this is not what we do, and it's a gross misstatement of the fact.
How old is your business relationship with Epic Systems?
I wouldn't like to comment about this thing, but we don't have a very deep relationship with them.
It's not a very 10-year-old client or a 15-year-old?
It's not a client of TCS at all.
Okay. Yeah. Okay. Let me just shift focus and talk about what lies ahead. When we started FY16, there were 5 headwinds. I was counting on my fingertips. It was Japan, it was LATAM, it was India, it was energy, it was telecom. And for FY17, the management commentary seems to be indicating that Diligenta is a headwind, but that headwind also will fade away. So indirectly, the management commentary, not a guidance, the management commentary seems to be indicating that there are better days coming.
Management commentary is what the management commentary is.
I'm just trying to read it.
So let's look at
facts on the table.
Yes, absolutely. And you're right about the facts. In fact, one of the most positive things, which was a big drag, over and above Diligenta, insurance itself was a weak sector, and that is the one that we are most positive about. We believe it has bottomed out, and it will grow well into the next year. It grew only 7% compared to 14.8% for BFS, and we believe that we have seen the bottom of it, and it should strongly grow into the next year. On Diligenta, we should see a bottom of it sometime over the next 1 or 2 quarters. And telecom is more difficult to call. The combination of telecom, high tech and media continues to be a bit of a volatile sector. So that one is more difficult to call. And Japan, we'll have to wait and see. So it's a bit of a mixed bag. LATAM is very strong. We believe that it's volatile, but it has delivered a decent quarter, and as we look forward, we see sustained strength in that. So the portfolio has a positive bias on the portfolio of problem cases, and that should help us as we go forward.
Ajay, where do you see utilization rates stabilizing for FY17? Because you've not shied away in the past from giving us a broader utilization number or utilization outlook.
Utilization, I think, will continue to be operating at the level where we are at this point in time, and as we have been maintaining that as you grow, the scale comes in, and that's advantage of the scale. You start deriving that advantage of the scale. So as a percentage, it does not make much of a sense beyond a certain point, because what is not being utilized are people who are not on customer projects. So they are on various investments that you are making, they are on training, and they are on various internal projects and things like that. So given what you have the capacity to execute for your internal projects and the investments that you make, that would drive the utilization going forward. So I think we are pretty confident of utilization where we are. and maintaining those utilization levels. And it's a pretty efficient and optimized kind of a system that is running at this point in time in TCS, and I think we will be maintaining that rigor of operation going forward.
Rajesh, you exiting the year at when your margins are at the lower end of the band. Let me just quickly outline the concerns for FY17. Concern number one, US visa cost will be a challenge. It is presidential year. Concern number two, US labor market has improved, which means there would be a wage pressure in that market. And concern number three, the natural appreciation which IT companies have enjoyed because of a weak rupee, that may be missing in today's environment.
Each of the concerns are valid concerns, and each of them has a negative impact on the margin. But there are equally offsetting positive elements also. Sustained growth momentum in the larger segments of BFS and North America will provide better margin sustenance. Our strong growth in digital, and as we achieve scale in the various digital as a aggregate is at about 2 billion, but the individual service lines are still smaller, and as we increase scale in each of those service lines, they will also move from an investment phase into a mature profitability kind of a phase. So we are making significant investments, whether it be in learning systems, whether it be in starting off new service lines, whether it be in experimenting with new business models, and each of them should result in some good output, and that will give us the margin support. So what you said is right. There are headwinds to margins, but there are equally opportunities for improvement, and the trick is to balance the two and to see how we scale. We remain very flexible in our approach towards managing the business. We are always focused on investing into growth, investing into new areas, whether it be new businesses, whether it be new markets, and our investment cycle will continue as long as we see opportunities out there. We have been very focused on ensuring that organic growth is supported through investments, and we've been able to build a 2.3 billion digital business with practically zero inorganic acquisitions. That's a phenomenal achievement, and which is showing through in very strong cash flows. We are exiting the year with 22.5% cash, and for the full year we have done 21.5%. We have distributed about 10,000 crores in dividends, about 9,000 odd crores, and our total cash balance has gone up by another 10,000 crores. So very strong cash performance, very disciplined one, organic growth through core basic investments into our existing assets and repurposing these assets for the new businesses. So I'm very happy with our overall margin and cash performance through the year, and remain quite confident as we look forward.
So 26 to 28 will remain there for FY17, irrespective of the cross-currency movement and irrespective of the wage hike.
The wage hike is part of our business. Cross-currency is more difficult to call. Currency has an immediate impact on the margin because it flows through. We'll have to wait and see. So think about it this way, that the currency and inflation go hand in hand. And wage hikes and inflation also go hand in hand, but all of them happen with lag effects. So broadly they kind of balance out as you go forward. If you were to see substantial reduction in the inflation side, expected inflation side, our wages will also follow that, and currency would also react to it. So it's unlikely that you will see each of these three go completely out of step over a sustained period of time. Quarter on quarter it's a much more volatile environment, and we are not managing it on that basis either.
Ajoy, middle of FY16 you said that TCS is committed to training, and you've nearly trained 1/3 of your workforce. 66% is still need to be trained. Are you working on that?
Oh yes, we are continuing to train our people on digital technology.
Can you share a number with me?
We have not kept a target, but we would like to see, finally digital is something that we are saying is all permeating. It's all industry practices. Everywhere digital is going to come in. So our end goal would be that everybody should have the digital knowledge. At the same time, the advantage is the fresh or the new people who are coming in and joining us from the colleges and from the institutes. They are the one who are the natives of digital at this point in time. So they do have that knowledge. But we do have to train them on some of the newer technology and how these are being applied in order to find or to provide solutions to our customers' problems. So those trainings will continue, and our focus on getting everybody trained on this platform is absolutely there.
Rajesh, digital now accounts for nearly 15% of the total business. We are looking at size, we are looking at scale here, and on a large scale, large size, the digital business is still growing at an astounding number of 50%. When will the base effect kick in?
Digital is a much more heterogeneous play. As I said, I mean, a lot of it is new, a lot of it is repurposing of existing ones, because existing services are morphing into digital, incrementally morphing into digital.
But when you're classifying your 15% business as digital,
yes,
I would assume that this is new business, right?
Not all of them necessarily, because it's as we said, that is why we are not putting it as one service line more inside our service line mix. It's rather a vertical cut on our service lines to give you an idea about what is the new business that's coming. It's a very heterogeneous space. Almost like Ajay said, every single existing service line of ours will morph into digital over a period of time. But it's a very exciting space. It continues to drive new opportunities and new investments, and we believe that that's the locomotive for growth as we go forward.
Okay. So Rajesh, closing comments. Let me first phrase my question. It's more like a fill in the blank. For FY17 TCSs, and your options are, we're not playing KBC here, but I'll give you 3 options: excited, confident, or super excited.
You did this to me last year and I said all 3, but this time I'll say the first 2. So excited and confident, yeah.
Okay. Gentlemen, appreciate your time. Good luck, and I'm glad that I'm officially using the headline that after 6 quarters, TCS numbers have managed to beat the estimates.
Thank you very much.
Thank you very much.
Thank you.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.